Hey everyone, Jio and BlackRock have just launched their first actively managed mutual fund in India, the Jio BlackRock Flexicap Fund. And it's already creating a lot of buzz in the investment community. Because unlike your regular mutual fund, this fund is being pitched as the next-gen fund powered by artificial intelligence, data, and BlackRock's world-famous investing platform. But the big question is it really an opportunity for Indian investors or just another hype story? That's what we are going to discuss in this video. We'll cover the Jio BlackRock Partnership, what each brings to the table, then what is the USP of Jio BlackRock Flexicap Fund. Next, we'll discuss stock shortlisting funnel using Aladdin, which is BlackRock's proprietary risk and optimization engine. Then we'll discuss the fund details, including the pros and cons, and the final verdict, what should you do, who should invest. Alright, let's get started. To begin with, Jio BlackRock Partnership is unique. On one side, you have Jio, that is part of Reliance Group. After conquering telecom and digital, Jio has all set its eye on the next big frontier, that is finance. Through Jio Financial Services, it wants to democratize financing and investing by bringing banking, credit and investment into the hands of every Indian. On the other side, you have BlackRock, known as the godfather of asset management. With over $12.5 trillion under management, it controls more money than the GDP of some of the largest countries in the world. BlackRock is not just about size, it's about brain. They built a platform called Aladdin, which is a technology that BlackRock relies on to manage risk, crunch data, and construct portfolios. Now, what happens when Jio's unmatched reach and digital muscle meets BlackRock's expertise and technology? That's the story we are talking about today. The two of them have come together to form Jio BlackRock Asset Management with one clear mission: to democratize investing in India. In plain words, to take world-class investment tools that were once reserved for billion-dollar institutions and put them in the hands of everyday Indian investor. And the first product born from this partnership is the Jio BlackRock Flexicap Fund. Now let's discuss the USP of this fund. Friends, Jio BlackRock Flexicap Fund is not the first fund in the category. There are already many Flexicap funds in the market. So the big question you should ask is, what makes this fund stand out in a market that is already flooded with Flexicap funds? The reason is, today, most Flexicap funds in India follow a star fund manager model. The fund manager and his team usually look at companies' financials like P&L, balance sheet, cash flow, then annual report, quarterly reports, con call, of course, valuation, they look at it, that include PE ratio, price to book ratio, and also a few macroeconomic indicators. The research universe is often 300 to 400 companies, and the portfolio ends up being with 30-40 stocks. On paper, it looks neat, but here is the problem. It's only part of the picture. Because today, companies leave behind a digital footprint that tells us much more than quarterly results. Think about it. How many people are searching for a brand online? Are people actually visiting stores in different cities? What are consumers spending on in real time? What is the sentiment on social media? This is the modern approach, and this is where Jio BlackRock's systematic active equity, that is SAE, shines. By the way, you can also fetch the entire presentation available on their website. So instead of relying only on traditional financial data, SAE approach uses more than 400 signals, combining the old traditional approach of financials, quarterly report, earning call with alternative data like blogs, job posting, e-com data, satellite data, social media content, and internet search. That's where instead of analyzing just typical 300-400 companies, Jio BlackRock's approach starts with more than 1,000 Indian stocks and narrow them to about 750 investable ones based on liquidity, turnover, and execution feasibility. That's nearly double the research coverage of a typical AMC. Each of these 750 stock is analyzed on more than 400 signals that we discussed earlier, and every stock gets a scorecard based on this rule-based model. Then comes the corporate governance filter. High scores alone are not enough. Every stock must pass a corporate governance filter, meaning companies with questionable practices, poor disclosures, or governance red flag gets kicked out. This keeps the portfolio clean and investor friendly. Now the shortlisted stocks goes through Aladdin, BlackRock's proprietary risk and optimization engine. This is the same platform used by some of the world's largest institutions. Aladdin looks at portfolio level risk, sectoral exposure, and transaction cost. Plus, fund manager also provide the input. It ensures the final portfolio is benchmark aware, so it does not go totally off track, but still optimized to generate the alpha. Now, SAE is definitely looking very interesting, but the big question is, does it really work? That's where backtesting comes in. The SAE model has been tested across 10 years of Indian market data from 2015 to 25, and here is what the results showed. The SAE strategy delivered a CAGR of around 20% over 10 years. In comparison, the benchmark delivered only around 15% CAGR. That's a solid 5% alpha every year, and compounding that over a decade makes a huge difference. But here is what impressed me even more. It wasn't just about returns. The information ratio, which measures how consistent the excess returns are, was also higher. Volatility was relatively contained thanks to the diversification of 120 to 150 stocks versus 30 to 40 stocks in traditional funds. And the performance wasn't dependent on one or two lucky stock picks. It was broad-based across sectors and market cap. So instead of trying to time the market or big bet on a few names, SAE's backtest shows it can capture small gains across many stocks while managing risk better. Of course, a backtest is still a simulation. It's not the same as live performance. But the fact that it worked consistently over different cycles that include bull market, bear market, COVID crash, recovery does make it more credible. So far we have focused on the SAE model that tells the half part of the story. The other half is the Aladdin optimization engine that is a proprietary tool of BlackRock. Let's discuss it in detail. Most mutual funds you see in India still rely on a fairly manual process. Analysts build models, fund manager picks stocks, risk team check exposure, and then someone else monitor transaction. It's all fragmented. Aladdin changes that. It unifies the end-to-end investment management process on a single platform. It looks at portfolio risk in real time. It calculates the transaction cost before a single trade is executed. It runs optimization model to ensure diversification and balance. And it helps fund manager stress test the portfolio across different scenarios, like what happens if crude oil spike or what if the rupee depreciates sharply. Think of Aladdin as the operating system of global investing. In fact, many of the world's top financial institutions pay BlackRock just to use this platform. Now here is the exciting part. Through the Jio BlackRock Flexicap Fund, for the first time, Indian retail investors get access to a portfolio that's constructed and managed using the same technology trusted by trillion-dollar funds worldwide. So while traditional funds may still depend heavily on human intuition, here you're getting a portfolio backed by data, AI, and Aladdin's institutional-grade risk management framework. Now let's discuss the fund details, including both pros and cons. Since it's a Flexicap fund, it has the freedom to invest across large, mid, and small cap. Basically, it can capture opportunities across the entire market spectrum. The fund will be benchmarked against the Nifty 500 TRI. The NFO window is open from 23rd September to 7th October 25. The fund will be managed by Tanvi Kacheria and Sahil Chaudhary. Both of them bring solid experience in equity research and portfolio management. And above them, the leadership team include Sid Swaminathan, the CEO, and Rishi Kohli, the CIO, who both come with deep expertise in global asset management and quant strategies. On the cost side, the expense ratio for the direct plan is around 0.5%, which is very competitive compared to most active funds in the category. And here is something investors will like. There is no exit load. So to sum it up, it's a broad-based Flexicap fund, benchmarked to Nifty 500, backed by an experienced leadership team, competitively priced, and with full flexibility for investors. Now let's quickly look at the pros and cons. Let's start with the positives. So this is India's first systematic equity fund, a process that blends machine intelligence with human judgment. It is designed to cut out bias and build portfolio in a disciplined way. Second, the fund has wide diversification with 120 to 150 stocks. That means your risk is spread out. Even if one or two companies underperform, it won't drag down the entire portfolio. Then third, it is powered by Aladdin, BlackRock's global risk and portfolio management system. This is institutional grade technology that some of the world's largest investors use. And now retail investors in India can benefit from it too. Fourth, the cost is competitive. The direct plan expense ratio is just around 0.5%, which is quite low for an active fund. And there is no exit load, which gives investors flexibility. And finally, the backtest results look strong, around 20% CAGR growth over 10 years compared to 15% for the benchmark. Plus, it showed more consistent risk-adjusted return. So on paper, it looks really solid. But let us look at the cons. So first con is this is a new AMC. Jio BlackRock as a fund house does not yet have a live track record. Although BlackRock capability and backtest are encouraging, but the real outperformance would only be visible over time. Then second, with 120 to 150 stocks, there is a risk of over-diversification. The portfolio may end up hugging the benchmark too closely, and the outperformance might only be modest. Third, the fund is heavily dependent on its model. If there's a sudden shock like COVID, policy changes, or geopolitical event, models may not capture it in real time and performance could suffer in the short run. So yes, the fund has exciting strength, but also risk that investors should carefully consider. Now let's discuss the final verdict. Let's start with who should consider investing in this fund. First, if you believe in India's long-term growth story and want a broad, diversified exposure across large, mid and small cap. Second, if you like the idea of a data-driven, bias-free process rather than depending on a star fund manager's instinct. Third, if you are comfortable with a long-term horizon, say 5 years or more, because that's when systematic approach like SAE usually deliver their edge. And if you want to benefit from institutional grade tools like Aladdin, but at a retail investor cost structure. Now, who should avoid it? So if you are looking for quick short-term gains, this is not designed for speculation or chasing momentum. Also, if you prefer concentrated high conviction bet, this fund spread itself across 120 to 150 stocks. So it won't give you that thrill of more than 30% return from a single name. Also, if you are uncomfortable with the fact that this is a new AMC with no live track record, some investors may prefer to wait a year or two and see actual performance before committing. So in short, this fund is best suited for long-term, process-driven investors who value consistency over hype. But it's not ideal for those chasing quick return or who don't want to experiment with a new style of fund management. That's it for the video. Now tell me in the comment, what do you think about this new offering by Jio BlackRock? If you find this video useful, do share it within your circle. I'll see you next video. Till then, take care.